Joining me with a look at REIT market performance is NAREIT Vice President of Research and Industry Information, Brad Case. Brad, 2009 was a great year for REITs. 2010 has gotten off to a bit of a slow start. Some investors are wondering if the rally's already at an end. How would you address that?
Oh, I don't think there's much concern about that. You know, the conditions in the commercial real estate market have set REITs up for extremely strong earnings going forward. And that means that the people who are expecting to see positive returns in REITs are not looking for 1 month returns or 6 month returns or even 1 or 2 or 3 year returns. They're really looking at the current market situation as the beginning of what's likely to be a very long bull market in REIT stocks. The normal real estate market cycle is about 18 years. And given that we've had a downturn and the first 9 months of an upturn, that still suggests that we're probably looking at something like 16 years of generally positive results going forward. Now that doesn't mean they're going to be positive every month. There are going to be negative months in even the longest and strongest REIT upturn. But most investors are not looking at 1 month returns. They're looking at what they're likely to be earning over the next several years.
And what are some signposts you would tell investors to watch for that long-term performance?
Well, interestingly, the signposts that probably matter the most to REIT investors are not so much in the commercial real estate space, because information about the health of commercial real estate has already been priced into REIT stocks, and REIT investors are looking far beyond that. What's really most relevant is probably going to be information about the health of the banking sector, the financial services sector. And the reason I say that is because we're in a situation right now where commercial property values are still declining, and many investors have gotten themselves into trouble because they paid top dollar for those properties, and their loans are underwater. Now the banks have been willing to extend those loans even though the values of the properties have gone down, and that's because the federal government regulatory agencies have been trying to protect the health of the financial sector. As we go forward, as the financial sector becomes stronger, then the federal regulatory agencies are likely to start insisting that banks recognize the decline in values. That's going to push an increase in commercial mortgage defaults. And we're going to hear about that in the newspapers. But those are not, generally speaking, going to be defaults on mortgages to REITs. They're going to be defaults on mortgages to private side real estate investors. And those defaults are going to have the effect of releasing the properties to the market at just the right time for REITs to pick them up and use them to increase their earnings going forward. So interestingly, good news about the health of the financial sector will result in bad news about the commercial property sector as a whole, and that will be good news for REIT investors.
And picking up the idea of confusion, there still seems to be an issue when looking at the public market versus the private. Where is the confusion coming from?
I think we're likely to continue to see that confusion because of exactly the dynamic that I was talking about before. Remember that REITs are in a position to acquire properties when those properties become available. And they will become available because of distress on the private side of the real estate market. And so investors are likely to continue to hear bad news about the real estate market, but they'll have to keep in mind that that's bad news about the private side, not about the REIT side. And that sets up REITs to make good acquisitions going forward.
Thanks, Brad. For REIT.com, I'm Matt Bichard.